Hello everyone, welcome back to the final part of chapter 2, Money and Banking. Congratulations if you have watched all the previous parts. You have already built a strong understanding of money, commercial banks, the Reserve Bank of India and monetary policy. But we are not finished yet. Today we are going to learn the remaining monetary policy tools used by RBI, open market operations, moral suasion and margin requirements. These topics may look small in textbooks but they are important for board exams and help you understand how the RBI manages the economy. We'll also revise the entire chapter through some tables, flowchart and memory tricks, expected questions and a complete chapter mind map. So this video is useful whether you are studying the chapter for the first time or revising it before your exam. Let me begin with a simple question. Imagine inflation is increasing, but the RBI does not want to change the repo rate immediately. Does it have any other way to control money supply? Yes, it does. That's exactly what we are going to learn today. By the end of this lesson, you will complete the entire money and banking chapter with confidence. Now let's study one of the smartest tools used by Reserve Bank of India, open market operations, commonly called OMO. At first, these terms may sound a little technical, but actually it's very easy to understand. Let's imagine a simple situation. Suppose the RBI wants commercial bank to have more money, so they give more loans. Instead of reducing repo rate immediately, the RBI has another option. It can buy government securities from commercial bank. What happens then? The RBI pays money to the banks. Now the bank have more cash. With more cash available, they can lend more money to businesses and individuals. As loan increases, investments and spending also increases. This support economic growth. Now let's look at the opposite situation. Suppose inflation is rising very fast. People are spending too much and there is excess money circulating in the economy. The RBI now wants to reduce money supply. How can it do this? It sells government securities to commercial banks. The bank purchases these securities by paying money to the RBI. As a result, banks have less cash available for lending. So when lending decreases, credit creation also decreases. Over time, this can help reduce inflationary pressure. So remember the simple rule, RBI buys security means money goes into banking system, means more money supply. RBI sells security means money comes back to RBI, money supply decreases. So think of this as easiest tool to understand if you focus on direction of money. Think of it like a water tank. If RBI pours water into a tank, the water level rises. If RBI removes water from the tank, the water level falls. Similarly, RBI can increase or decrease the amount of money in the economy through open market operations. So students often forget to mention government securities in the definition. Always include these words to score full marks. Now let's learn one of the easiest topic in the chapter, moral suasion. The name sounds complicated, but the concept is very simple. Let's first understand the meaning of the word persuade. So suppose your teacher says, I advise everyone to revise chapter 2 before tomorrow's class. Is it a strict legal order? Of course no, it's advice. Most students will probably follow this because they trust the teacher. The same idea applies here. Sometimes the RBI does not want to use strict monetary policy tools like increasing repo rate or CRR. Instead, it simply advises or requests commercial bank to act in a particular way. For example, if inflation is increasing, the RBI may advise banks to be more careful while giving loans. Or during economic slowdown, it may encourage banks to lend more productive sectors such as agriculture, manufacturing or small businesses. So notice something important. RBI is not forcing the bank. It is trying to influence their behavior through guidance, discussions, meetings, circulars and policy communications. This method is called moral suasion. So let's understand with a simple life example. Imagine your parents tell you, it would be better if you save some money instead of spending everything. They haven't forced you, they have simply advised you. You are likely to listen because you trust them. Similarly, commercial banks generally take RBI's advice seriously because RBI is the country's central bank and the regulator. That is why moral suasion is called qualitative method of credit control. It changes the behavior of bank through persuasion rather than compulsory legal actions. So in your definition, always write the word persuades, advises or requests commercial bank. These keywords are important. Now let's study the final monetary policy tool used in this chapter, margin requirement. Don't worry about the name, it's much easier than it sounds. Let's begin with a real life example. Suppose you have gold jewelry worth 1 lakh. You go to a bank and ask for loan. Do you think the bank will immediately give you the full 1 lakh? Usually no, the bank may give you only 80,000. The remaining 20,000 is called margin. In simple words, margin requirements is the difference between value of security and the amount of loan granted. Now let's understand why banks do this. Banks keep a margin to protect themselves from risk. Suppose the value of pledged gold falls or the borrower is unable to repay the loan. The margin provides a security or safety cushion for the bank. Now let's connect this concept to monetary policy. Imagine the RBI wants to reduce excessive borrowing in the economy. It may encourage banks to maintain higher margin requirements. If the margin requirement increases, the customer receives smaller loans against the same security. Smaller loans means less borrowing. Less borrowing means lower credit creation. And lower credit creation can help reduce excessive growth in money supply. Now imagine the opposite. If banks reduce margin requirement, customer can receive larger loan against the same security. This may encourage borrowing and can increase credit in the economy. Let's take another example. A person pledges share worth rupees 5 lakh. If the bank decides to keep a margin of 1 lakh, it may grant a loan of 4 lakh. If the margin is increased to 2 lakhs, the loan amount may be reduced to 3 lakh. So remember, higher margin means smaller loan, lower margin means bigger loan. That is why margin requirement is used as qualitative method of credit control. So in the definition, don't forget the word market value of security and loan granted. These are important CBSE keywords. Now let's compare qualitative and quantitative method of credit control. This comparison is frequently asked in school examination. First, let's understand the meaning of the word quantitative. It relates to the quantity, which means the overall amount. So quantitative tools are used when the RBI wants to influence the overall money supply, credit in the economy. Example, repo rate, reverse repo rate, bank rate, CRR, SLR, open market operations. These tools affect almost the entire banking system. Now let's understand qualitative method. The qualitative refers to quality or direction of credit. Instead of changing the total amount of money in economy, these tools influence how and where credit is provided. Examples are moral suasion, margin requirements. For example, if RBI wants bank to be more careful while lending against certain securities, it might use margin requirement. If it wants bank to follow a particular lending approach without making legal changes, it may use moral suasion. So the biggest difference is quantitative tools change the amount of money. Qualitative tools influence the direction or quality of lending. Think of a school. If a principal changes the timetable for every class, it affects the whole school. That's quantitative tool. If the principal only advises one class to improve discipline, that is qualitative tool. So in comparison question, always write the answer in table. It's easy to understand and usually scores better. Students, this is probably the most important slide in the entire chapter. If you understand this one flowchart, you will remember every monetary policy tool. So let's begin with the situation where RBI wants to increase money supply. It can reduce the repo rate, it can reduce the reverse repo rate, it can reduce bank rate, it can reduce CRR, it can reduce SLR, it can buy government securities through open market operations. What happens then? The commercial bank have more money available. They lend more, business invest more, consumers borrow more, economic activity increases. Now let's look at the opposite situation. Suppose inflation is becoming very high. The RBI wants to reduce money supply. It can increase repo rate, it can increase reverse repo rate, increase bank rate, increase CRR, increase SLR, sell government securities through OMO. As a result, banks have less money available for lending. So borrowing slows down, credit creation decreases, inflationary pressure may reduce. Now notice something interesting. All these tools are different, but they are trying to achieve the same objective, maintaining economic stability. So some tools increase liquidity, some reduce liquidity. The RBI chooses the most suitable combination depending on economic conditions. So instead of memorizing each tool separately, understand whether it increases or decreases money supply. That's the key idea. Now let's apply everything we have learned to real situations. Imagine inflation in India is increasing rapidly. Food prices, fuel prices and transport costs all are rising. What should RBI do? It should adopt which type of monetary policy? Contractionary. So this means increasing rates like repo rate, CRR, SLR, selling government securities through OMO. These steps reduce the money available for lending and can help control inflation over time. Now let's look at another situation. Suppose businesses are not investing, unemployment is increasing, economy is slowing down. The RBI may adopt expansionary monetary policy. So it can reduce repo rate, CRR, SLR and buy government securities through OMO. This increased liquidity encourages banks to lend more and supports investment and economic activity. So whenever you see a case study in the examination, don't memorize the answer. First, identify problem is it high inflation or slower economy? Once you know it, choosing the correct policy becomes very easy. Now this table is your last minute revision guide. Instead of revising 6 separate topics, revise this single table. Notice the pattern. If the RBI wants to reduce inflation, most policy rates are increased. If the RBI wants to encourage growth, most policy rates are reduced. So understanding the pattern is much easier than memorizing individual definition. So spend 1 minute revising this table before exam. It can help you answer multiple objectives and descriptive answers. These are some of the most important questions from this chapter. Don't just read them, pause the video and try answering them yourself. If you can answer these 6 questions confidently, you have covered almost all the important concepts from chapter 2. Okay, so now the chapter is over. Now go through the video slides and try to revise the concepts, and finally you have completed this chapter. So from understanding the meaning and functions of money to learning about commercial banks, credit creation, Reserve Bank of India and every major monetary policy tool, you have now covered the complete chapter. Remember, economics is not about memorizing definitions. It's about understanding how the economy works, how different policies affect people, businesses and the country. Before you leave, I have a challenge for you. What monetary policy tool would you use if that the fastest impact of economy, and why? Write your answer in the comments and I would love to read your ideas. If this chapter helped you, please like the video, share it with your classmates and subscribe to the channel. In the next video, we will begin chapter 3, Determination of Income and Employment, where we learn how national income is determined and how equilibrium is achieved in the economy. Thank you for watching. I'll see you in the next chapter. Till then, keep studying, keep learning. Bye bye.